Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Anthropic is reportedly eyeing one of its biggest acquisitions yet, a $6 billion deal for AI startup Decart to help it squeeze more performance out of its computing infrastructure. Plus, CoreWeave warns investors that shifting from its exclusive use of Nvidia AI chips is going to cost them time and money. And Cerebras also out with results, shares sliding after underwhelming growth. We're going to talk to the CEO later this hour. Let's get right to our top story. Bloomberg's learned Anthropic is in talks to buy AI world model startup Decart AI for about $6 billion, according to sources. It would be Anthropic's biggest acquisition yet. Bloomberg AI reporter Shirin Ghaffary, Bloomberg Deals reporter Ryan Gould, both with us now. And actually, Shirin, I want to start with you. Yes, there's the world models element of this, but Decart does something else that will be appealing to Anthropic as it hopes to get the most out of its compute.
Right, and that's basically maximizing the efficiency out of chips. And not just Nvidia chips, but other types of chips like TPUs and Amazon's Trainium chips. And so that is important in a time when obviously Anthropic and the AI vendors are in a crunch trying to be able to keep up with demand and offer all the compute they can get.
Ryan, take us into the deal here. We're saying that this would be Anthropic's biggest acquisition. To me, $6 billion seems quite modest in the landscape of deals we've been covering of late. But of course, around the corner is an expected IPO.
Exactly, Ed. And I think, it is or would be Anthropic's largest known deal to date. Who knows what they've been doing behind the scenes. I think it's just super interesting in terms of timing, as you say, that IPO coming as potentially as soon as October, which is, really not that far away at all. I think when you put this into perspective for Anthropic, doing this kind of deal as a private company is perhaps a little bit easier than as a public one. And I think it might actually help them to communicate that story, at least on the cost efficiency side, a little better when it comes to, that finalized S1. They did obviously file confidentially, but this acquisition itself would not obviously show up in that existing filing. I think $6 billion is modest, but you've seen this company it just raised at a $4 billion valuation not so long ago. That round was backed by Nvidia. And I think if we just pause a little bit on that, I think I saw someone make a point online this morning that Anthropic itself is starting to look a little more like Nvidia, as well as being an Nvidia competitor. And I think to put that into like the sum of things, who knows how that'll be valued, how investors will credit that at the time of IPO.
Shirin, you cover this company as closely and as deeply as any journalist on the planet. I'd really love to understand what their M&A story has been to date. They are a frontier lab, born out of research, working on frontier models. Have they gone out shopping to buy the other bits that have completed their business?
Anthropic has been quite disciplined, both in their early kind of compute efforts. You had Anthropic CEO Dario Amodei saying he didn't want to sort of YOLO and go too far with overextending on compute. They've similarly been more disciplined than some of their competitors on their M&A strategy so far and haven't made as many splashy big deals. If you think to OpenAI buying Johnny Ive's startup or other major headlines, Anthropics have been a little more under the radar. So this would mark, as we reported, their biggest acquisition yet and may represent a shift where, as Ryan was saying, ahead of a potential blockbuster IPO, they are starting to make some of these bigger transactions in areas where they may need help.
Ryan, Anthropic has raised, I think, more than $100 billion just year to date in those two mega rounds that they did. I'm sure most of that's on the balance sheet. Decart, it's reported, was looked at by Musk and SpaceX AI. What are you seeing across the field at the moment? Like, this is an active space. There are lots of transactions happening at all kinds of levels.
I think that's true. I think you saw that report out of Israel earlier on this week that I think put SpaceX's name next to Decart. Elon obviously came out and denied that report. I think what I would say, taking a step back about Anthropic in particular, is we know, and we have spoken to many people who are on the sidelines over the past few months, that they have been quite actively shopping for acquisitions. Obviously putting in this in the context as well of them trying to build out their own chip effort, they were looking for something on the hardware layer too earlier this year. I think this is a company that's really trying to make that vision a lot clearer, again, as I say, ahead of the IPO. And when you look at across the street and think about some of these other sort of chip inference type plays, efficiency plays that are coming out on the market, like, we've been covering Tenstor, and Ed, you know it well.
Yes.
These are all types of deals where I think companies like Anthropic are realizing that there is actually massive value here, and there are still quite few of them at scale. So it's kind of a scarcity play, I think, at this point.
And in each of those cases, they've gone after startups that have a very clear specialism, very clear niche. The team's updated the story on the Bloomberg. I'd go and read it in full. Bloomberg, Shirin, Ghaffary, and Ryan Gould. Thank you very much indeed. Let's go to public markets. The S&P 500 is just at fresh record highs. And like a lot of that is the story year to date, storage, memory, some of the high-flying chip names. But the next guest says you don't have to own the mega caps to play the AI boom. She sees opportunities in mid caps, from the companies powering the build-out to those actually using AI to boost productivity. Laurie Keefe, Parnassus Investments portfolio manager and senior analyst, joins us now. There's picks and shovels, but picks and shovels can be big or small or somewhere in between. And we've become so focused on this small group of ginormous technology companies. We talk less about the rest of the field, and that's the field that you play in.
That's correct. Thanks, Ed. It's great to be here. And absolutely, I mean, we're seeing really this opportunity broadening out beyond just a small group of players which have really powered the CapEx trade so far. And we're seeing that broaden out to many of the companies that maybe aren't even thought of as AI companies per se. They're not known as technology companies, but you're seeing the value chain expand beyond just the compute, the memory players, into areas like water and power. I mean, these are critical areas when you look beyond the value chain that are going to be needed to support the growth of AI and data centers. And so there's a number of really interesting opportunities, I think, that sit beneath the surface in the mid-cap arena that we find very attractive.
I'm really interested in how that's played out over time. If you take high bandwidth memory as the example, it's been quite some time where high bandwidth memory is part of the server design. And it seemed like overnight we were like, oh my goodness, everyone needs high bandwidth memory. Is that analogous with what's happening in power and water? People are saying, uh-oh, we better do something.
I think it is. I mean, there's obviously a lot more challenges as you move to the law of physics around implementing some of the power needs that are required to support all these data centers. And so there's, I think, a whole breadth of opportunities that aren't necessarily as focused on. But when you think about not only the data centers around the need for power and energy, but also water, when you look at the scarcity of water, the water treatment that's required all the way from the actual development of the chips into the data centers for cooling. That's another really interesting area that I think, as an enabler, those companies that are providing those technologies are going to be very well positioned when you look out over the next 5 to 10 years.
When you look at the Mag 7, there's a lot that's analogous between them. They are hyperscalers, or they have similar business models, or they rely on the same partner, Nvidia. In the mid-cap segment, there's a lot more diversity.
Very much so.
It's a bigger field. Like that. How do you pass all of that?
Yeah, it's a great point. And I would say within the large cap arena, when you look at the concentration in the index, in the large cap index, roughly about 40% of the index is driven by 10 companies. When you look at mid-cap, the largest constituent is actually closer to about 70 to 80 basis points. So a lot more dispersion, a lot more opportunity set. And I'll also say, you notice from a valuation perspective, you've got large caps trading today close to 21 times. You've got small caps closer to 25 times. And you've got mid-caps around 17 times. This is a very attractive value prop relative to comparable earnings growth that we see over the next few years. And so we think there's a lot of great opportunities. Again, and also the concentration, the sector composition is quite different than large caps. So you're able to diversify away from this what is becoming a more crowded trade into areas that will benefit from AI, but they're not dependent upon AI. So a lot of the opportunities that we focus on have AI as an enhancement.
Did you give a case study?
Absolutely. So let me start with a company like Hubble, which is one of the leading providers of equipment that goes into the grid and supporting the build out. That opportunity set was already there before AI, as there's a need to modernize the grid as you're diversifying your power sources, transitioning away from coal. So that is actually getting enhanced by the need for more data centers and the need for more power. So that's a great opportunity. On the user side, though, I would also point to even a company like a Robinhood. Robinhood, actually, there's a whole host of companies when you look out, where's the next spectrum of opportunity? Those are companies that are able to leverage AI to improve their business outcomes, to improve their competitive advantages. In terms of Robinhood, they are now powering about 75% of their customer service calls using AI. So that is leading to very tangible benefit, as well as incorporating that into engineering. Those certainly, it's early days on the user side from an enterprise perspective, but we think there's a really long tail as those users start to adopt AI and strengthen those competitive advantages. We should see that over time broaden beyond the use cases around customer service and engineering that most companies have focused on so far into things that help to really drive margin. Mm-hmm.
We started this conversation saying the S&P 500's at another fresh record high. I mean, stocks go up and down, of course, but one of the biggest contributors or best performers these days is Western Digital.
Yes.
That's probably is a more crowded trade. Yeah. You know, the story is quite well known at this point, but it is a name that you hold and that you think about. Where does it fit in your broader thesis?
I think absolutely it's a key enabler as you look at the need for storage as AI, the amount of data, the amount of compute that's driving all of the LLMs that are driving new data. The hard disk drive business will continue to be really relevant, and we think there's a long secular tail for that. So we've actually held that for a while, for the last couple of years, but we still see a nice runway for growth given the opportunity there. Mm-hmm.
Laurie Keefe of Parnassus Investments. It's been great to have you here in the studio. And Nessa, thank you very much.
Thank you so much.
Indeed. Another stock that we're watching today is Cerebras, and the stock is under pressure. You know, it's another high expectations earnings story. The stock's down 14%. There's questions about the lumpiness of hardware sales and why renting out compute capacity is slightly eclipsing that. We're going to speak to the CEO, Andrew Feldman, later in the hour. Okay, coming up, we also have more earnings. Cisco reporting fourth quarter results. Disappointing investors despite beating estimates in the quarter gone. It's all about the AI revenue outlook, which we'll go through next. This is Bloomberg Tech. Cisco reported fourth quarter earnings disappointing investors after the company projected it would make $7.5 billion for sales tied to the AI data center boom, a number investors deemed conservative compared to prior figures like $9.3 billion over the past year. Bloomberg Intelligence's Jin Ho joins us now. The problem is reconciling a backlog with forecasted AI revenue and how much of overall revenue is AI revenue. Where did your math net out?
Yeah, so Ed, thanks for having me on. Look, I think the AI revenue of $7.5 billion was quite fine. You know, they already guided to $6 billion in the last quarter results for fiscal 2027. You know, I think the hang-up with investors, quite frankly, Ed, is more on the gross margin side than anything else. They did 66% gross margins in the fourth quarter, guided to 66% in the first quarter. But it seems like there's going to be like 100 to 150 point basis drop off in gross margins in quarters 2 to 3. So the earnings power isn't as strong as people had hoped for the full year.
Right. The $9.3 billion figure I referenced was the orders for AI-related gear that it's amassed over the last year. And so they're saying, okay, you've told us here's a backlog and here's how much revenue. Is it a conversion rate issue?
Yeah, there is some conversion rate. Look, the timing of the conversion rate is a little bit unclear as well, which may hold back some of that, and some of those sales is going into fiscal 2028 as well, right? And the issue is that it's not going to be, it's not unique to Cisco. We're hearing the same thing on all the optical players. We're also hearing the same thing on the semicon players as well, primarily because of supply tightness.
You know Chuck Robbins, right? I think he said this was prudent as opposed to conservative. Does it matter that the market interprets a set of numbers as conservative?
Yeah, look, I think given the big run-up, look, the stock has been up over 50% year to date. Expectations have been heightened heading into the print. And I think they were expecting higher numbers on the gross margin side, earnings, as well as on sales when they reported 27 guide.
Why are expectations so high that Cisco's going to be a winner along with everyone else in this field?
Yeah, if you think about like the two hottest spaces in the AI play, right? Aside from GPUs, optics, as well as some of the networking silicon. Cisco has both of them, and they're very well positioned in both of them. And the optics play, I mean, we're not only seeing a 100% growth, we're seeing about 150% growth, right? And Cisco has been a #1 market share leader there. And on the silicon side, there's deeper penetration there. So expectations of Cisco doing well on both ends in the hyperscale cloud side have been fairly high heading into the print. So, and they expect that to move on going forward.
Bloomberg Intelligence's Jin Ho. Great to have you back on Bloomberg Tech. Thank you very much. CoreWeave warned its investors that moving away from its exclusive use of Nvidia chips will cost the company, quote, time, investment, and resources. That was in a regulatory filing, a change driven in anticipation by strong customer demand. Bloomberg's Brody Ford joins us now. CoreWeave's a neocloud, and 100% of its existing customers rely on compute that is based on Nvidia architecture. The problem is all those customers are thinking about life after Nvidia, right? That's the story here.
Exactly. Most people see neoclouds like CoreWeave as these kind of vassal states of Nvidia. They sell their tech to some extent. They do what they're told by Nvidia. And so any sign of daylight between the large neoclouds and Nvidia is quite interesting to us because it just suggests that are the chips shifting? Currently, Nvidia is the undisputed king for AI chips. Of course, you ask any big customer, Meta, Microsoft, Amazon, any of them, they hope that's not the world they're in a couple years. And so it will be interesting to see if that plays out. How do the neoclouds adapt?
Right. Nvidia also owns 10% of CoreWeave, effectively. Yes. Has CoreWeave ever said anything about the future silicon or compute platform plan? Like, are they in talks with anyone else other than Nvidia? Or is this them just saying, like, heads up, this is a possible risk?
They've been asked a few times directly. Most recently, I could find in December, and they pretty much said what people want is Nvidia, and we're going to keep giving it to them. But this is a change in their language, right? And I think monitoring these small changes in language, clearly somebody at CoreWeave was saying, hey, let's change this for a reason. And I think it's a very interesting clue about how the chips may be shifting in the coming quarters.
Real quick, Brody, earnings earlier this week were good for CoreWeave.
Oh, I mean, if you're a CoreWeave investor, you had a beautiful week. Rev was up, the margin story was beautiful. And so, yeah, the bearishness against neoclouds has dissipated a bit this week.
All right, Bloomberg's Brody Ford on all things neocloud. Thank you very much indeed. Take a look at shares of StubHub. Lower today. Earnings forecast underwhelming, pretty significant story, but a similar story to what we've seen throughout this earning period where the company went in with high expectations. The stock down 13%, almost 14%. That had been down even more than that in the pre-market session. Now, coming up on the show, SpaceX clears its first major lockup test. Why the feared wave of selling never materialized. That's next. This is Bloomberg Tech. Let's get over to New York, where Bloomberg's Yahara Anand is standing by. Hi, Yahara.
Hi, Ed. It's time now for Talking Tech. First up, CXMT is now China's most valuable company after surpassing Tencent, showing that the sky-high demand for memory chip stocks showed no signs of slowing down. The switch reflects investors' continued preference for AI-linked hardware over traditional internet champions. Plus, also, China's largest ride-hailing platform, Didi, swung back to a profit after previously reporting back-to-back quarterly losses. The company reported a net income of $128 million, with revenue increasing 11% thanks to China's strong ride-hailing demand. And SpaceX saw its highest intraday level jump in over a month after releasing a new AI model called GrokBot. The new software is designed to handle a wide range of professional work, including signing into various apps and websites and allowing bots to share details and context with one another. Ed?
Also good at coding and long-running tasks. Thank you very much, Yahaira. Let's stay on SpaceX. Shares had surged 35% post-lockup expiry through yesterday's close, adding roughly $500 billion in market value and defying fears that a wave of insider selling would pressure the stock. But several more lockup expirations are ahead. Investors are bracing for more volatility. Bloomberg's Carmen Reinicke joins us with what we need to know. And, it's a calendar thing. In August, there's more. In October, there's more, and next year, there's more.
Yep, it's something that we're going to just keep seeing, potentially adding pressure to this stock. Although going through the first one, it seems like investors didn't have a ton to worry about. We saw pressure heading into the lockup, especially with Wednesday's earnings report sort of coinciding right ahead of when those shares did lock up, but that ended up being the low for the stock for now. The next day, shares jumped and they rallied 35% over the next 5 days. We're seeing a little bit of selling pressure today, but that's pretty expected after a 10% jump that we saw yesterday on that Grokbot news. So a lot of strength here. I think it gave investors some confidence that there wasn't a lot of selling with that first lockup. It was the biggest one that we'll see, and it was more shares sort of coming online than even actually in the IPO. So a very good sort of first hurdle, as investors have said, for the stock, but more pressure coming up. In 1 week, we get the next lockup expiration.
Next summer's the big one, right? That's when Elon Musk shares, subject to very specific lockup terms, hit the market.
Yes, you're right. So about a year after the IPO is when that happens, and then sort of all of the available shares will come online and we'll have the total float, for everyone to trade. And we'll see what happens. I mean, the first year of trading post-IPO is so volatile, and we know that there are often large drawdowns. I mean, SpaceX has already seen a huge drawdown, over $1 trillion in market value lost from, the top a few days after the IPO through last week's bottom. So lots of volatility here is to be expected continuing, and I think we're going to see it in the year to come.
Carmen, really quickly, there were two very large numbers Elon Musk touted on the earnings call. How are investors thinking about that?
I think those are of paramount importance, right? We know that so much of what investors are looking at here is that future bid, right? It's Elon's vision. And so if you're a bull, that's what you're focused on. You're saying the valuation doesn't matter. That's what I'm investing on. If you're a bear, you're a little bit more, scrutinizing that figure. So those goalposts are very important.
100 billion ARR by year end, $1 trillion of revenue in 2030. Bloomberg's Carmen Reinicke. Thank you very much. So coming up, IVP General Partner Cack Wilhelm joins us. We're going to talk about investment opportunities in the AI infrastructure layer and probably a whole lot more. It's halftime here in the beautiful city of San Francisco. Stay with us. We'll be right back. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Stocks at record highs, the S&P 500 at a fresh record high. Really, there's some economic data underpinning that. Technology shares are pushing higher. The Nasdaq 100 up a percentage point. Outperformance in chips. That's kind of been the story through this middle earnings cycle, where we've had a lot of the neo clouds. Of course, we had the big Nvidia announcement earlier in the week, and that has carried the chip sector with some momentum. In private markets, there's a lot going on too. Let's get to today's big number, $190 billion. That's Databricks' current valuation after raising $5 billion in funding, its second round of financing this year. The fast-growing software firm, which competes with the likes of Snowflake and Alphabet, also said that it crossed $7 billion in revenue run rate. Confirmation of a story I think we've reported quite recently. We started talking today and started the show on Anthropic's efforts to buy Decart for about $6 billion, according to sources, in what would be its biggest acquisition yet. It comes as some of the biggest AI companies are spending to build and run their models, and it raises questions about where the value's moving in AI right now. I've got an amazing person to talk to about that. Cack Wilhelm is general partner at IVP, where she focuses on high-growth companies and the AI infrastructure layer. And it's great to have you here on Bloomberg Tech.
It's great to be back. Thank you.
I want to start with a general question about buying and building organically. At all layers of the 5-layer cake stack, all of that's happening at once. Some people are building, some people are out in the market. What is it that you see most in your portfolio?
Yeah, good question. So we're venture capitalists, right? We're trying to invest in all these companies. Some of them we're going to sell to bigger companies, but the ones that we love are the ones that go all the way, right? The ones that go Series B to S&P, as we like to say at IBP. So we're investing in the likes of
Series B to S&P.
Series B to S&P.
That's the internal mantra.
I mean, we joke. Yeah.
Okay, sorry, I didn't mean to interrupt you.
Yeah.
I just like that.
No. So we're investing in the likes of the Databricks and Decarts, hopefully those 10 years ago versus today. I think it's no surprise that Nvidia is acquiring something like, I said Nvidia, I meant Anthropic. Anthropic and acquiring a Decart, because what you have in Decart is you have, it's a world model, but I think that the reason that they're acquiring Decart is because of this inference optimization.
Yes.
And that is like one of these layers of the stack that's becoming a super hot commodity.
Software to make the chips run better.
Absolutely.
In simple terms. You're an infrastructure investor. Your background is in software infra. Where do you focus right now? What is your sort of area of expertise and the lane that you're most focused on?
Yeah, so very much software infrastructure and cybersecurity. Different reasons for the two. I learned this lesson very viscerally as a kid. Like, my first job out of college was working at Oracle, selling databases. And in a single day, I was a sales rep. I visited Chevron, Intuit, and Marmot, like the tech clothing brand. And I was astounded at the range, like sort of the breadth of industries, but then the breadth of use cases too. And that was the moment that it was like, you know what, these infrastructure companies have vast markets and TAMs. And if you build something hard that no one else wants to build, these can be long-term compounding businesses.
What are some of the sort of, I don't know, I guess you'd say you don't have a favorite child, but in the portfolio, like, which companies, are your favorites right now that you see having the most potential?
Okay, well, let's tie this to public markets. And if you look at the top 10 trading names, you have to get all the way to number 8 or 9 before you get to a sort of a conventional software SaaS company, right? And 1 through 8 are Palantir, CrowdStrike, Palo Alto, Snowflake, Cloudflare, etc. There's a reason that these businesses trade so well, and it's because revenue compounds with usage, right? And like implicit in that is it is uncorresponding to seats. I've totally forgot the question.
The question is which are your favorites?
Oh, so my favorites are the ones that do that. So my favorites are ClickHouse. My favorites are Perplexity, a usage compounding business. My favorites are Cribble, LangChain, Base 10. All of these are technical founders building technical products, selling into a technical audience. And once you have them, the net dollar retention, or like the accumulating usage from those accounts, is well over 150%.
Really interested in Perplexity. They seem to offer a much broader range of things now than their origin. One way that you could explain it to us is when you make the sponsorship or pitch to the rest of the partners on why Perplexity, what is the future that you'd outline to the team? Why you'd back them?
Perplexity was easy. It was 2 things. So it was September 2023. It's about $2 million in ARR, as compared to the whatever Arvind has said publicly, $500 million. This is 3 years ago. It came down to 2 things. Number 1, the CEO. Arvind is in a class of his own, a technical wizard, extremely ambitious. And number 2 was as simple as they ship product quickly.
Yes.
Right? And that is a compounding advantage in this environment. So I think the mistake with Perplexity is thinking of it only as an answer engine, just as the mistake with thinking about Anthropic as just a model company. That shortchanges both of those companies dramatically, right? Perplexity was the first to be an answer engine. It was also the first to launch a browser, Carmen. It was the first to launch deep research. It was the first to launch a computer agent with computer. And so that is a usage compounding story, right? Because you put all those things together, and as revenue scales with usage.
We could sort of stop for any period of time and say, there's a lot happening in AI. Are we in an AI bubble, et cetera, et cetera? I would ask you, what is the trend within AI that you have identified? What do you think is happening within all of the companies that you're backing that is less talked about at the moment?
That they have insatiable interest and demand.
But that's not changed, right? Demand is still running far ahead of the industry's ability to supply.
Right, exactly. I think someone said this morning that they could sell their whole 2027 book today if, given the chance. Now, you wouldn't want to do that. But I think that the thing that people are missing is we can simultaneously be in a golden age of technology, which I think unequivocally, I mean, I'm a diehard optimist, but I think unequivocally we are. And we could have a capital markets adjustment. I won't say correction because that's probably a technical term. But that wouldn't negate the fact that it wouldn't say that the trend is fake. It would just say that we have a timing mismatch. And we probably have timing mismatches all the time. I just think we're in I mean, there are going to be different phases of this sort of AI proliferation, and we're still in sort of the individual productivity phase. So if you're a corporate CEO, you might be underwhelmed, right? Because you're like, where is it showing up in the numbers? But if you look back, I mean, think of, I think it was 1987, the MIT Nobel economist, Richard Solow. He said the computer age is showing up everywhere except in the productivity stats.
Yes.
But that was in 1987, yes. Right? And look today. I mean, he's also famous for the Solow paradox, which said, which is really obvious today, but that general purpose technology will show up in long-term growth numbers, which unequivocally it has. And so I think right now we're probably in this expectation mismatch where you have it showing up in productivity, but it's a little bit more individual, and we need it to flow through to workflows and then to just absolutely transforming companies.
I'd love to end the conversation by learning a little bit about IVP. You know, what the partnership's guiding principles are, what you're trying to do differently.
Yeah, I mean, honestly, the thing we're trying to do differently is that we have done the same thing for 46 years.
And that ain't going to change.
If we can invest in 10 companies of consequence a year that have the potential to be generational companies, only 10, right? We don't want decision fatigue. We invest in 10 companies a year. That's our mission.
Is it harder to resist the urge to invest?
Absolutely. But venture is a picking business.
Yes.
Venture is not a index coverage business. And hence we stick to we do one thing well, and that's invest in 10 companies a year.
It's okay, based on reporting, therefore, if some funds have 50% write down. You just say 50% of these didn't work out. I'm asking for an insight to the reality of how that works in the end.
Oh, yeah. I mean, in venture, you have to adjust quickly that you can't flog yourself for the losers. Because the losers are in service of the winners, right? Across my portfolio, probably one or two companies will make up the vast nugget of returns versus the long tail.
I guess my question was, that's still true in the AI age?
Oh, that is more true today than it was yesterday, and it's 5 times more true than it was 5 years ago. Yeah. I mean, look at this morning, right? Lovable raising at $13 billion, and Cognition raising at $40 billion. I mean, I think there are these just crowned winners, and those are going to be the ones that return all the returns in venture capital.
And I think what you said earlier is look at the companies that can ship product. Cack Wilhelm from IVP, it's been great to have you here.
Thank you, Ed.
Vanessa, thank you very much indeed. Now, coming up, a Cerebras shares slide after the company projected slower growth than some investors had anticipated. Some bulls out there wanted more. We'll speak to CEO Andrew Feldman, who joins us next. This is Bloomberg Tech. Okay, for just the second time since its IPO, Cerebras reported quarterly earnings yesterday after the closing bell, offering some investors growth that was slower than anticipated. Shares down 13.4%. I think that's on track for the biggest drop since the last week of June. Cerebras CEO Andrew Feldman joins us now. The first thing that I learned was there is a business renting out compute capacity that's still there. Could you give me the backstory on that, Andrew?
Oh, of course. There's a huge business of renting out compute capacity. I think it's what the neoclouds do. It's what the hyperscalers do. It's a very profitable business.
And is it outpacing the growth from the business of selling the hardware direct to others?
Well, we have two parts of our business. We have a first-party cloud. That means we design, manufacture, and deploy equipment in our own data centers, and we rent it out to our customers. That part of the business was up 281% year over year. Huge growth. Now, in that part of the business, we control the data centers. There's another part of our business where we sell our our AI hardware to customers who want to do the exact same thing, who want to deploy the equipment and either use it for themselves or break it up into little pieces and sell the compute to various customers, right? Those customers, we call that our hardware business. We're selling hardware for their premise. And in Q2, some of our customers didn't have data centers available, so we were able to deliver less to them. And so right now, data centers are a challenge for everybody. We had some. We were able to deploy them for our own use and for the use of our cloud customers, our first-party cloud customers. And so that business is absolutely ripping.
We're live on Bloomberg Television and radio with Cerebras CEO Andrew Feldman. And the reason I asked for the backstory on that is that cloud business was born out of needing to build data center capacity to test the technology worked. It seems to be working.
It was. You know, we wanted to be able to provide demonstrations to customers without having to move hardware to their facilities. We didn't have a hyperscale customer at that time, and so there was a need to find a way to deliver compute services to people who didn't have a data center, didn't have a way to otherwise enjoy our blisteringly fast AI hardware. And so we set it up at first for ourselves and then for demonstrations, and there was so much demand on it over time that it's become a big business for us. And last quarter, Q2, it was an extraordinary business for us. And we expect it to continue to grow at tremendous rate. Now, even though now we have hyperscale customers like AWS, now that we have frontier labs like OpenAI, that business continues to grow at exceptional rates.
Okay, the hardware business, there is some confusion out there. You report on a core basis, which showed that the hardware division was up, right? On a GAAP or non-core basis, it would be otherwise. Just explain the story for the hardware business.
The story is one of our large hardware customers had some warrants, and those warrants are subtracted from revenue. The value of those warrants are subtracted from revenue in GAAP accounting. And so it made the numbers look a little smaller than they were actually.
Demand is great. It's there. There is a backlog. We know about it.
And we've got 25.4 billion in backlog.
So here is the data that people are really searching for with Cerebras, which is how can you get the capacity in place faster, both on your own data centers or to get the hardware into the hands of customers for theirs?
Right. And that's a fair question. What we said on our call yesterday is that we had signed up or had already live 600 megawatts of capacity, and that we had a pipeline of gigawatts of additional capacity. And what we said was that we expect our revenue to more than triple next year. And so I think we have been executing at a tremendous rate, adding 600 megawatts in several months, 6 or 7 months is no small feat. And we will add vastly more in the months to come. And so I think we are ahead of plan. We beat guidance and we beat consensus on the things on our core business, on core revenue, core gross margins, and beat by a lot on core operating margins. And then we guided a big raise, so for 2027 and 28. So we feel really good about the business, and are proud of last quarter's results.
Andrew, what are the biggest factors on the supply chain side or on the operations side that are impacting your ability to deploy that capacity?
So there are several things you need to do on the supply chain, right? First, we just talked about data centers. You need a place to put your equipment so you can build the cloud so that you can deliver it to your customers. Walking back upstream, you need manufacturing capacity, and we've expanded our capacity by partnering with Flextronics and Sanmina and Rocket EMS, we will this year increase manufacturing capacity by more than 10x. Walking further back upstream, you have to work with your fab partner. Our partner is TSMC, and they have assured us supply that will support our growth. And so we've systematically worked each of these components in a field we call capacity to have more chips, more manufacturing capacity, more data centers to put these chips to build the cloud offering.
The stock's down 14% right now as you and I are talking. You know, since the IPO, it's performed. I think the stock was up 42% from yesterday's close. Is lockup expiry a factor here? You know, we talked earlier in the program about SpaceX's lockup and the mechanics of that. Would you say that you see an impact of that in your case?
We do. There are lockups that are expiring, and there are people who invest against those. Those aren't the investors that we're focused on. We're focused on long-term investors. We're focused on delivering returns through investing in our people, in our technology, that will play out over years. And when you guide to more than a triple next year, and say that 28 is going to be giant, and 29 as well, we're trying to speak to people who want to be with us on this ride, and who want to be in the AI business and want alternatives to say Nvidia, and that's who we're talking to.
Andrew, I appreciate it's only been a few weeks since this was announced and you were on the show, but how's it going with AMD? Are engineering teams already working together? Have you moved quickly on that?
I enjoyed that conversation when you had me on your show a few weeks ago. I appreciate that. And it is, you know, Lisa Su and Mark Papermaster, they acquired my last company, and I had an opportunity to work with them for several years, and I enjoyed it a great deal. We have a good relationship there, and we have disaggregated solutions running in our labs. We have close engineering relationships. These are talented engineers on both sides, working extremely hard, and we will have deployments in the fourth quarter.
And very quickly, there was customer demand after the announcement.
There is enormous customer demand. Disaggregated solution provides the best of both worlds. It allows GPUs to go faster. GPUs are good at throughput and not so good at speed. They allow GPUs to go faster, and Cerebras, which is really good at speed, and we can improve in throughput. And so the disaggregated solution gives a faster, high throughput solution. And that gives you both the economics, which is throughput, and the customer experience, which is speed.
Cerebras CEO Andrew Feldman back on Bloomberg Tech. Thank you very much indeed. Meta says it has shut down more than 750,000 Instagram and Facebook accounts in Australia, believed to belong to users under 16, to comply with the country's landmark social media ban. The ban's being watched closely to see if it curbs social media use among young people, though a report last month by the Australia's online safety regulator said it led to only a marginal reduction after taking effect in December. That brings us to another big number, $1.4 trillion. That's the potential financial penalty Meta says it could face in a landmark social media addiction trial kicking off in California next week. A coalition of 29 state attorneys general allege Meta engaged in deceptive business practices affecting millions of young users, and that led to a mental health crisis. Let's get the details with Bloomberg's legal reporter, Madlin Mekelburg. You know, it's a big number, the potential penalty. But this is us teeing up for something to come this week. What do we need to know?
That's right. It's a massive number, especially when you consider what Meta's market value is, which is $1.5 trillion. So if this figure actually came to pass, it would be staggering and record-setting in the realm of civil litigation. I think it would be the highest penalty ever levied. But you're right, the trial started this week with jury selection, but next week we're actually going to get into the substantive arguments when we're going to hear opening arguments from both sides about this case, and then we're going to kick off in about about a month of testimony. We're expecting to hear from Meta CEO Mark Zuckerberg and other executives at the company, as well as folks from these state attorneys general's offices who are going to talk about what we can expect, or what they're saying is the impact that these policies at Meta have had on individuals in their state.
Madlin, what is literally the legal issue that will be debated here?
This is an interesting case because it's different than one that we've talked about before. Loyal viewers will remember the case that we heard about in Los Angeles earlier this year. This is about a bigger question than just harm to an individual user. This is about harm to a broader population. As you said, they're alleging a mental health crisis, and they've said that these algorithms and these tools that are being employed by the companies are contributing to widespread issues. It's compared often to the litigation against big tobacco because it's about whether or not this company is considered a public nuisance and is causing harm to individuals in a broad population.
Very quickly, Madlin, just this morning we've heard from Meta. What are they saying going into the trial?
Meta's kind of maintained the same line across all of these cases. As I said, this is one of several cases, but of course a very significant one. And they've said that they have safety features that they believe help make these experiences for young users safe and that their work has been sufficient.
Bloomberg's Madlin Mekelburg, thank you very much. Some breaking news. OpenAI is naming a new chief revenue officer for the second time in less than a year. This comes as an effort to bolster sales growth ahead of a highly anticipated Wall Street debut. The AI startup's hired Dali Rajic, president and chief operating officer of the Alphabet-owned cybersecurity firm Wiz, as its new revenue chief, succeeding Denise Dresser, who leaves OpenAI to pursue other opportunities following a transition period. That does it for this edition of Bloomberg Tech. Recap the show on the podcast. You know where to find it on the terminal as well as online on Apple, Spotify, and iHeart. This is Bloomberg.